Good morning. Well, we are now going to move on to the third of the budget chapters. The first two chapters dealt with preparing the operating budget of a business. The last chapter was talked about converting a static budget into a flexible budget, and then dealing with standard costing and the variances of the three product costs from the actual budget. So now we're going to talk about Chapter 22. This is basically reporting. This is giving feedback to those parties within a business that are responsible for the various revenues and costs. And costs are where a lot of the budgeting comes into play. So of course, companies put together budgets, and they want to keep a handle and control their costs as best they can. And one of the very best ways to do that is to simply periodically compare the actual results of operations to the budget and give feedback to those people that are responsible for it, so they know if they're doing a good job or if some correction needs to be taken. So that's why this chapter is entitled Performance Measurement and Responsibility Accounting. And responsibility accounting simply means reporting variances to those responsible for various items. So anyway, we're going to talk about a few things here: responsibility account, profit centers. I'm hoping to get through these first two in this video, and then we'll pick up the last part in a second video, so the video doesn't get too long. But I don't know that this chapter is really a difficult chapter, and there's not a lot to do for me to do in the way of presentation display of my own. They do a pretty good job in the chapter, but I may throw in some examples as we go. Let's just see how this goes. Going to go forward here a little bit, get past the pictures. Okay. Now here's what we've got. We've got responsibility accounting is really, like I said, it's performance evaluation. And it's that evaluation is based on comparing the actual results of production and to the budgeted level that we're looking for. The chapter starts off talking about how organizations are, how they're put together. And because unless we're talking about my little donut shop or maybe a little taco truck or something, when we get into larger businesses, one person cannot manage every department of every store in every state. So many times companies will what are called decentralize their organizations. And decentralizing them is what? It's divided into these smaller units. So we may have a manager for each store. And within the store, there's a manager for each department. And that's what they're doing, is they're decentralizing the organization into departments and putting somebody in charge of that particular department. That means that we've got responsibility accounting issues, we've got reporting issues to each one of those people that are in charge of whatever segments we've created. So they need feedback as to how they're doing, and that's what, as an accountant, that's what I'm going to be providing them with. Now, each segment, and maybe we'll think about it as like a department. In a grocery store, we've got various departments, and that's how that grocery store was decentralized. Now, every department can be identified as either a cost center or a profit center or an actual investment center. Now, these are, you can think of these as getting larger and larger as we go. Now, what is a cost center? And you could even use the interchangeable term cost department. What is a cost department? Well, a cost center is a department that has does not generate any revenues. They're a department within an organization, but they don't generate revenues, but they do incur costs to fulfill their function. For example, in a hotel has a housekeeping department. Now, the housekeeping department, the person in charge of housekeeping is not responsible for generating revenues. They're not responsible for room sales or anything like that. But their department incurs costs. And what are their costs in the housekeeping department? Well, they've got labor, obviously. They've got to hire people to clean the rooms. They probably have uniform costs. I think for the most part, larger hotels provide uniforms to their housekeeping staff. They have cleaning supplies. They have that as well. And so I think those are the major costs of the housekeeping department. They aren't responsible for revenues. So the person in charge of the housekeeping department think of it this way. If revenues are down, are we going to go yell at that person? No, they're not responsible for it. Other examples of a cost center within a organization is the human resources department, or the maintenance department, or perhaps the payroll department. Yeah, these are all departments that are incurring costs to fulfill their function. However, they don't generate revenues, and therefore they're not held responsible for those revenues. Moving up the line, a profit center is a department that does, in fact, generate revenues and is responsible for generating revenues. Let's go back to the hotel example. The restaurant is a profit center because they are incurring costs, but they're also responsible for generating revenues. The lounge, if the hotel has a lounge, that's a profit center because they're generating revenues as well as incurring costs. I would say probably the front desk or sales of the hotel. They're the ones that are responsible for generating the room revenue, getting guests in there, and they're incurring costs to do so as well. Within a department, a grocery store, well, the departments we see are all profit centers. Produce department, dairy, canned goods, their meat department, all probably have a separate manager from all the other departments, and those are profit centers. So therefore, they're responsible for not only their costs, but revenues, and therefore they're responsible for generating a profit. Finally, an investment center. An investment center is a larger item. It's in our grocery store. An investment center would be the entire store. Whoever's responsible for putting that grocery store there, wherever they put it, they are responsible not only for the revenues of that entire store and the costs of the entire store, but also for the underlying investment that was made within that store as well. So this may be a good place to do a quick example. Okay, maybe we have a guy that works for Vons, and he's a pretty high guy. He's pretty high on the food chain here, and so he decides that that we're going to put a grocery store in Fresno, maybe just somewhere. We find a corner, and so it was his decision. Let's go ahead and put that grocery store here, and within that grocery store, there's going to be a produce department, and there's going to be a dairy department. There's going to be the meat department. There's going to be the what's one more? And we'll call it the canned goods. Out there usually in the center of the place, canned goods. Also within this department, also within this store, which we normally don't see, there's accounting. These are the people that are keeping track of things. There might be a purchasing department, and there might be the checkout department. Somebody's in charge of all the checkers. Okay, well, as far as this goes, each one of these departments has a manager, and it has a manager, and there might be an overall store manager that's overseeing the whole store. Now he answers to him, and they answer directly to the store manager. So where are the cost centers? Where are the cost centers? Well, accounting is a cost center. They don't generate any revenues, but they're incurring costs. Purchasing is a cost center. Checkout is a cost center. Where's the profit center? Well, here's a profit center, profit center, profit center, profit center. And for the store manager, this is a profit center, because he is responsible for generating profits in this store, as well as in controlling the costs. So from his perspective, he's dealing with a profit center here. From this guy's perspective, he's dealing with an investment center, because not only is he going to be held responsible for the profits that are generated here, as well as the costs, he's responsible for the underlying investment. So it could be that when we look at the profit center of this guy right here, the entire profit center, we may say, well, the total revenues this month were $1 million, and the costs were $900,000. Therefore, profit was $100,000 this month. And so, well, he's generating a profit, and that might be, and so he may be fulfilling his responsibility, and he may be generating the exact same profit as somebody at another store. So hey, they're doing okay. But what about this guy? He actually had this store built, and the store actually cost $10 million to build, and that's probably not that is probably not an unrealistic estimate. Think about a house, a standard 3-bedroom, 2-bath house costs, $250,000 to build. Our office here, we don't have a large office. I don't know, we have 15,000 square feet. I think it costs $2.5 million to build. So think about a store like the size of Vaughn's. That's probably at least a $10 million structure. So he's responsible for actually making this investment. And is that a good return on that investment? Well, let's see. That's $100,000 divided by 10 million. That's a 1% return. I don't know if that's a good return or not. So he's usually the investment center is usually his decision is usually not based on the fact that we made money, but how much money did we make given the underlying investment. So we'll see more of these. I just wanted to draw a little picture to show that we're talking about the same store, but depending on where we are in the food chain, we may be at costs, we may be just dealing with a cost center, we may be dealing with profit centers, or an investment center as well, being responsible not only for everything that's going on there, but the underlying investment. Okay, let's go back to the book. Moving on. Within, now we're generating costs in every one of these centers. Every one of them has costs. So even the smallest of them all, cost center, is dealing with costs. But we want to talk about some costs. We've talked about fixed versus variable costs, and I think that's really the only thing we've talked about. But now we want to talk about what's a controllable versus an uncontrollable cost. Now, a controllable cost is exactly what you would think it would be, is that it's a cost that a manager can control. It's usually in whatever center we're talking about, cost, profit, or investment center, we're going to be incurring costs. So what costs can I control? Let's talk about maybe the housekeeping department. They're probably going to be held responsible for labor costs, so the manager there can control labor costs. That's why they watch what wage increases they give. They try to keep overtime, not to incur overtime if possible, because that increases labor cost. They try to keep their employees as efficient as possible so that we don't incur those costs. Supplies, the cleaning supplies, that's a controllable cost. They are buying cleaning supplies, so they want to buy them at the best price because they're going to be held responsible for a certain level of cost. So controllable costs are those that managers within these departments can, at least to some extent, control. But there's going to be some expenses as well that we can't control, that they have no control over. Costs of their department that they have no control over. What would be an example of that? Let's see here. Going back to our example here, suppose that we didn't buy this building, but we're just renting it. We're actually just renting this building, and so we're renting it for, let's say $50,000 per month, and that again probably isn't an unreasonable amount. So we're renting for $50,000 a month. It's a cost of every one of these departments. So when I say, well, in the accounting department, what are your costs? Well, I have payroll costs, I have supply costs, office supply costs, I have utility costs, and I have rent costs. And the rent is a cost of the entire building, and it has to be allocated to all these departments. So how would we allocate the rent among all these departments? Well, we'd want to do it on some fair and equitable measure. I'd say square footage. The amount of square footage that each department occupies, that's the amount of rent that's going to be allocated to them. So So in this department, they've got payroll, they've got supplies, they've got rent, and if the accounting department occupies 10% of this building, well, then the rent allocated to them will be 10% of the 50,000 or $5,000. That's a cost of this department. Likewise, utilities. Utilities would probably be allocated the same way, based on square footage. And maybe utilities are 2,000, something like that. Okay, well, of these costs, what are controllable? Well, for the accounting manager, he's responsible for controlling payroll costs, so he may have to let some people go or that kind of thing. He's responsible for controlling supply costs, what the supplies he's consuming to do what it is he needs to do. But he is not responsible for the rent. Oh, it's a cost of the accounting department, but he had nothing to do with negotiating this rent or where this building ended up. This is an uncontrollable cost to him. Utilities is also an uncontrollable cost to him. Are these costs controllable by somebody? And rule of thumb is all costs are controllable by somebody somewhere. And so the rent and utilities are an uncontrollable cost to him. They are probably an uncontrollable cost to the store manager, but they would have been controllable to this guy right here. He's the one that decided to rent this store for $50,000 a month. So he's the one that made the decision to incur this. So these costs are controllable at his level. They're uncontrollable at this level. So I would just want you to think about all costs are controllable somewhere, but when we look at a particular cost center or profit center or investment center, who has control over it? They're uncontrollable to some people, but they are controllable to somebody else. Controllable versus uncontrollable costs. Let's see here. There's the food chain. So that's obviously these are kind of how the decentralized organizations moving up here. A responsibility performance report is simply this. It is simply comparing actual results to budget. And as we move up, I think they're going to use this example. So take a moment just to kind of absorb what this is. We've got what is this? A beverage company, I believe. And within the beverage company, oops, let me close this. Yeah, this will work. Within the beverage company, and I guess it's there's a beverage department, there's a food department, and then there's a service department. Okay, well, this is a profit center. Beverage and food are profit centers. This is a cost center. Service department's a cost center. These three departments are under the vice president of the West region. And under the vice president of East region, they probably have their own beverage department, food department, and service department. So they've got the same thing. This didn't show it here. So this person's responsible for these departments. And then both of these guys answer to the executive vice president, who answers to the president, who answers to the board of directors. So you can see the responsibilities going up and up and up and up. So as we move down the food chain here, we are responsible for less and less and less items until you get down to like a line manager, maybe in the housekeeping department. All they're responsible for is the payroll and the housekeeping supplies. But when you move up here to like the president, he's responsible for everything below them. That's usually what the case is. You're responsible for everything below them. So when we look at our results of operations for July, I'm going to start at the bottom. Actually, I think it's easier to start at the bottom. We're going to start with the plant manager of that beverage department, which was this guy right here. This guy. We're going to say, how did you do? We're only going to report to him those costs that are controllable. So for the beverage department, making beverages, he's responsible for materials, labor, and overhead in his department. Here was the budgeted amount, and that would be from the flexible budget, whatever level of activity he actually produced. What should the costs have been? Here's how he came out. This is what they actually came out to be. So we were over budget on materials, but we were under budget on labor and overhead. So he came out a net $300 over budget. So that's how he did. Now, does the vice president of the West region, does he have responsibilities? Is he also responsible for him? And the answer is yes. He's responsible for what he's responsible for, but he's also responsible for for his stuff, and he's responsible for his things as well. So the accounting department needs to give him a performance report for what he's responsible for, which includes these three. So notice as we do that, this particular plant, the beverage department, is included on the responsibility report that's given to that West Region Vice President. He's responsible for, here's the beverage department, and all we did was we just took the totals. We said, okay, well, here's what you're responsible for. Your controllable costs, what you can control, Mr. VP. Salaries of the department managers, depreciation, insurance, the beverage department, and of course, then I would actually probably print this out and staple it to this, so then put C attached, see the detail attached, the food department and the service department. So he's responsible for those departments that are below him. There they are, all three of them. Plus, he's responsible for the costs at his level. Now, are all those costs that he's responsible for, is the executive vice president, is he ultimately responsible for those? And the answer is yep, along with this guy, along with other costs at his level. So the West Region Vice President's totals actually become a line item on the next guy up, but he's responsible for the West Region and the East Region, as well as various costs at his level. And it could keep going up. If we did gave the president a report, it would include the totals of the executive vice president, which include everything below it. When I say that, his totals have a line item for the guy below him, which includes a line item for the guy below him. So, but the thing to take away from this is that we have in fact departmentalized this organization, and we are reporting the results of operations, comparing actuals to budgets to each person, and we're only reporting to them the costs that they can control. Like I said, the person at the top of the food chain would get all of them. Let's see, an example for you to go through there. Please go through the examples. That's how you learn. Okay, let's talk about profit centers. Remember what a profit center is. A profit center is a center that generates revenues as well as incurs costs. So because we're talking about revenues and costs, we are in fact responsible for generating a profit. Now, within those profit centers, we do have controllable versus uncontrollable costs, and we can also break down costs into direct expenses versus indirect expenses. And there is a lot of overlap between these, but they aren't completely. Now, here's what a direct expense is. We'll just talk about a direct expense is an expense that is for the benefit of one department, for one particular department. So, for example, the cost of cleaning supplies is a cost that's associated with the housekeeping department. So that is a cost solely for the housekeeping department. Or we may say that the sharpening of meat saws and knives for the meat department, that's a cost incurred solely for the meat department. It's not benefiting dairy, it's not benefiting produce. It's that cost of keeping the knives sharp is a cost of the meat department alone. So that's a direct cost. It benefits one department. What's an indirect cost? An indirect cost is, as you might imagine, is a cost incurred for more than one department. And that, think back to the rent. We're renting the building. Is that rent incurred for one department? Nope, it's incurred for all departments. So it is an indirect expense. It's an expense of all departments, but it's not directly associated with one department, so it's an indirect cost. Well, let me get this thing closed up. Okay. Direct expenses. Now you may think, oh, a direct expense, that's a controllable expense. Direct expenses, they are often, I can't even get that highlighted, they are often direct expenses, but not always. They're not always a controllable cost. Indirect expenses are normally uncontrollable costs, but maybe I could say they are uncontrollable costs. Yeah, they usually are uncontrollable costs. So, the indirect expenses, we have to find out a way to allocate them to departments. We don't have to allocate direct expenses because they only serve one department, so it's to that department. It's that department's expense. But indirect expenses like utility, security, rent, painting the outside of the building, maintenance and repairs of the building, property taxes, insurance on the building, pest control. Those are all indirect expenses of the entire organization, but we need to allocate those expenses to the various centers, the various cost and profit centers within the building. So we need to come up with a model to do that. And it's basically a lot of just common sense. For example, utilities, I'd say based on square footage that the department occupies. Same thing with rent. Wages and salaries of people that like the store manager's salary, that's an expense of the entire store, and therefore his salary needs to be allocated to the various departments. I don't think square footage would be a good basis for doing so. It may be maybe he manages several departments. We may just allocate it evenly. We have 6 departments. Maybe 1/6 of his salary is an indirect expense to each one of those profit or cost centers. Or maybe we'll do it based on the number of employees that he's managing in each department. So a department that has 20 employees versus one that has 2, well, the one that has 20 would be allocated more. Or if he spends, we can actually track his time and the amount of time that he spends managing each department. Well, we'll do it based on that, but we do have to allocate it to somewhere. And even though those are costs, a portion of the store manager's salary is going to be allocated to each department. Within that department, that is an uncontrollable cost. They have no control over his salary. Advertising may be allocated based on percentage of sales. So when we're advertising our store, we run ads on TV or radio or something, and we say, oh, we've got a produce department, a meat department, and that kind of thing. Well, we need to allocate that expense, that advertising expense, to the departments. Here they're doing it based on percentage of total sales. I think that's a good idea. A department that has a lot of sales has to bear a lot more of the cost of advertising versus one that doesn't have much in the way of sales. Service departments, which are the cost centers, these are the departments that exist solely to service the other departments like accounting and purchasing and maintenance and repair and housekeeping. Those need to be allocated to the profit centers, and I'm gonna kind of show you how they did that, how they allocated that. I think there's an example in here. So here we've got a store, a particular store. It has 3 profit centers. It's got a hardware department, it's got a housewares department, and an appliance department. It also has 2 service departments, which are cost centers. It's got the general office, keeping track of the revenues and paying the payroll and everything for these guys, and it's got a purchasing department, which is purchasing all the various things that these have. So each department is going to have its own direct expenses, those expenses that benefit solely them. There's also going to be indirect expenses, like the rent that we have to allocate to all of these. So, and that's what we've gone so far. So step 1 is to determine. Notice that we've got our 2 service departments and our 3 profit centers. Start off with sales. Yep, the sales of the profit centers. Notice there's no sales in general office or purchasing. It's common sense, right? It makes sense. They aren't there to generate any revenues. And we come up with the direct expenses, those expenses directly attributable to to each department. Cost of goods sold. course, the service centers are not generating any sales, so there's no cost, but there's the cost of the items that were sold by each department, the salaries for people working directly in those departments, depreciation of the equipment that's used directly in those departments, and the supplies consumed by each one of those departments. Then we have our indirect expenses. We've got the rent of the store, utilities, advertising, and insurance. Well, those are expenses that are not directly traceable or attributable to any particular department, so we need to allocate them on some basis. Step 2 is to allocate those, allocate the indirect expenses, and they did that based right here. They took them across. They did it based on the amount, or based on the square footage. So notice that this is just they brought this down. This is the direct expenses we had before. Then we allocated the rent to each department based on square footage. We allocated utility expense based on, or I guess they allocated rent amount and value of space. Okay, well, if it seems reasonable, utility expense is based on floor space, square footage. Advertising expense, well, that actually benefit just these 3 departments, not one particular department. So it is a indirect expense, but when we allocate it, I mean, there's no benefit to the service department, so it gets allocated based on relative sales to these the profit centers. Insurance expense, based on the value of insured assets. Well, they all have assets. So now we've allocated those. So now we've come up with the total expenses. Let's see if these add up. Yeah, if you notice, the total expenses we're talking about are $72,200. The direct expenses we allocated based on exactly, these are the real deal numbers. This is what they used. The indirect expenses we allocated to the various departments based on some reasonable basis. So now we have now allocated this whole $72,200 to the 5 departments. That's what these 5 add up to. That's what they add up to. Now the third step is to allocate the service departments now, because they are simply here to service the profit centers. We need to allocate their total cost to the profit centers. So we start with the general office department. The general office department is there to service the 3 profit centers, so we allocate their $15,300. It's this in itself, this total is an indirect cost of the profit centers. So we allocate that based on relative sales. And then the purchasing department, we allocate that. They're there to purchase for these 3 profit centers. So we allocate theirs based on number of purchase orders. And so all we've done is we've reallocated the cost center totals to the departments, the profit centers. And we get down to the bottom where, so the total costs, $72,200, have now been allocated to the 3 profit centers. There they are. They add up to $72,200. So number 1, start with your direct costs and trace them to the departments that they directly benefited. Take the indirect costs and allocate them to all departments, including cost centers. Third, take the total of the cost centers and allocate them to the profit centers, so you have all costs now allocated or directly traced to the profit centers. Now we can say this is how they came out. Here were the 3 profit centers. Here's their totals. There's their totals. There's the cost of goods sold. And here is our allocation, the $72,200. There's our allocation. We had our direct costs for each one. We had our allocated indirect costs. And then we had our allocated service departments. And these numbers are traceable right back up into here. So this is how all 3 departments did. Hardware department made $10,800. Houseware department made $8,700. Appliance lost $500. So overall, if you do the math down or you do it across, this store made $19,000. This month, is it a month? For the year. Well, that's not very good for a year, is it? Yeah. Now, initially, what someone who doesn't understand the costs, which is not us, we're getting a feel for how these costs work. Somebody who doesn't understand this would look at this and say, come in like you've got one store owner, one unreasonable, unlearned store guy would come in and say, well, we're closing this department down. Appliances, they're losing money. We're out of here. Well, that would be a mistake to do, because there is what's called a departmental contribution to overhead. This department is actually contributing to covering its overhead, because think about it this way. If we shut this department down, what's going to happen to the rent that's being allocated to the space that this department is occupying? Is that going to be avoided? And the answer is no. We're still going to have to pay rent on it. It's just going to be empty. Or is the insurance that we're paying for the building and the portion that's allocated to that particular department, is it going to be eliminated? And the answer is no. It's still going to be there as well. So all we're going to be doing is we're going to be eliminating only their revenue and their cost of goods sold. If we shut this department down, we're going to eliminate that, and we're probably going to eliminate their direct expenses. But the rest of these allocated expenses are simply going to have to be allocated to the remaining two departments. So what we need to do is, well, what is this department actually contributing to overhead? What's the contribution margin of this department? Well, here's what it is. Taking that income statement, we're saying that each department has its sales and its cost of goods sold. So this is right off that income statement. And then the direct expenses. Here's what each department is actually contributing to covering all those indirect expenses, which are aggregated right here. So yes, we are making $19,000. Yes, yeah, here it is. It's $19,000. $19,000. But if we eliminate this department, will any of these expenses go away? And the answer is no. But these will go away. If we eliminate appliances department, we are going to eliminate $9,500 of profit, and that's all we're going to do. And if we eliminate the hardware department, we're going to eliminate $29,400 of profit. These are the revenues and the direct expenses that are attributable to these departments. These are what we have control over, not these. So if we eliminate the appliance department, I don't know if they give an example of that, we're actually going to see our net income drop by $9,500, because all we're going to be eliminating is that. Yeah. Behavioral aspects. Indirect expenses are typically uncontrollable. Those indirect allocated expenses are typically uncontrollable. So therefore we should not, the managers of those departments don't even get a report. They don't even know how we're doing on those indirect costs. There's no reason for them to know, because they're not responsible for them. So, yeah. And back in this example, when we give the performance report or the budget variances to the manager of the appliance department, he's only going to see how he did on these items right here. Even though he has allocated certain rent and that kind of thing, his report will not include that. It's only going to include what he's responsible for. Yeah, a lot of this is kind of common sense. You just need to spend some time with it and go through the numbers in this chapter. Investment centers. Let's see here, hold on. Okay, right now we're about halfway through the chapter, a little bit more than halfway through the chapter. I don't want to make this too long. We're already at about 40 minutes. So I think maybe this afternoon or tomorrow morning I'm going to load the video discussing the investment center. Just want to kind of see how long this is. It's going to go through residual income, ROI, issues, turnover. Got an example here, non-performance. What is that? Yeah. We normally don't get too far into this end of the chapter stuff. Transfer pricing. Yeah, that'll be the last section, this investment center. So anyway, please review this chapter. The best information that you have is right here in the chapter. And of course, when you try to do the homework, that's how you learn it the best. If you get stuck, look at the corresponding B problem, look at the solution that's on Canvas, and see if we can get it worked out. Again, we're gonna have the next video on this, and then we're gonna have an exam, our multiple choice exam coming up. Let's see here. When is that multiple choice exam? I got my clipboard here. Next exam will be due on Sunday, this coming Sunday. So today's only Tuesday, so we have some time here. And so anyway, hope you're having a great day. Look for the next video, and we'll touch base then.